We just started the year and Hang Seng Index is down more than 8% already. If we look from a 1-year perspective, Hang Seng Index is down more than 32%. Today, I'll be discussing about Hong Kong stocks as well as China stocks in 3 key parts. The first, I'll simplify for you just in case you haven't seen news why their stock prices have came down that much. Second, I'll actually show you what are my exact holdings transparently. And third, I'll also show you possibly if you're keen in buying to China, what is the real tipping point, which is today's thumbnail, correct? And if you stay right at the very end, I actually show you a bonus solution if that tipping point doesn't come. So with that, let's roll in the intro video. Hi guys, welcome back. Let's start with the first chapter. Why has China and Hong Kong stocks came down that much? Right now, if you look in terms of finance news, you might see this term peak China, whereby China has developed to the best it can for the near term and might come down in the next few years ahead. There are several reasons why. The first is that real estate over there is faltering. You know, real estate has this wealth effect. In Singapore, right now, people upgrade from their EC and BTO. They make a first pile of 300,000 from that sale. And what happens is they'll use that to actually do an upgrade, correct? So that's a quick description of wealth effect. That explains also why for the last 10-15 years, Chinese tourists were the highest spenders in Singapore, Australia, Canada, Italy, you name it. That's because there were many who have benefited from this upswing in properties in China for the last 10-15 years. Many farmers who own land over there got bought out by developers and were flush with cash. That's how property segment can actually develop this wealth effect to the masses. But right now, what do we see? We see that Chinese consumers are pulling back on their purse strings, correct? That is why also, influencers in China, if they are to sell luxury goods, they're going to not do as well as those that are closing deals, selling cheap stuff and doing group buying on TikTok platforms over there. Not just that, you see that Pinduoduo, PDD, share price actually surged up more than Alibaba and JD.com. Quite simply because their target segment is the masses, whereas Alibaba and JD.com started to gravitate towards luxury, which is actually not doing too well. The second part on why China has came down that much is because of faltering economics. Right now, China has registered its slowest growth in 3 decades. If you see over here in the picture, you'll see a university graduate, correct? Lying down and feeling very awful maybe. And that's because he knows that he's going to the employment force and 1 in 5 of his cohort is just not going to find a job. China's youth unemployment is nearly 20%. And whether that's high or not depends on which country it is, correct? But for China, traditionally they were doing about 9.6% as mentioned at the bottom of the article. Right now, this is double the unemployment rate, which means many fresh graduates simply can't find a job. These are 2 points that describe China's poor prospects, at least in the next few years ahead. And it's little wonder investors are not too optimistic. And many times when investors are not too optimistic, they are definitely not going to beat sky-high prices for the shares, correct? And that's also the same and what is seen also in Apple's share price. Take a look at Apple's annual revenue on the left. You would realize it's been stagnating since 2021. That is the key reason why Apple has lost to Microsoft as the world's most valuable company, because prospects are very crucial to an investor's confidence in buying the shares, and that will naturally reflect in stock price performance. That is why many have hoped that PBOC, which is the Central Bank of China, would do aggressive stimulus ASAP. Instead, 1 week ago, they've actually maintained the lending rate at 2.5%, disappointing many speculators. Many presume that PBOC is keen to keep yuan stable because right now they are awaiting US Fed's action. Whether US Fed will signal an earlier or later cut, they are going to follow suit because if not, yuan might become unstable. So that's the general consensus. So with that out, let me show you my China exposure, what kind of losses I'm seeing. And before I get there, help me smash the like button and press on subscribe, especially if you'd like to follow on with content that emerges from this very interesting segment, which is in China and Hong Kong equities. So without further ado, let me show you my portfolios. The first one is actually one that I've created at the start of 2023. I thought that was quite close to the China bottom. Little did I wonder, there's still 1 year plus at least too early. Right now, it sits at 4,300 losses over the last 1 year plus. That's my smallest portfolio. The next I have is one that I've built up lump sums as well as do a dollar cost averaging. That has lost 18,300. And last but not least, this portfolio, which was actually the first one I created, was a 1,000 per week dollar cost average into China equities, and that is sitting now at a 15,500 loss. So all in all, my total losses are $38,100, representing a 33% loss from a capital of $115,000. From this, I can show you quite clearly, I'm not averaging blindly. My exposure to there is significant already. I cannot keep chasing losses, and there's a simple portfolio discipline. You may be starting from a different point, and hopefully you can take these pointers at heart when you execute your own investment strategy. Take note, whenever you buy bear markets, low can always go lower. It really is a test of patience. So luckily, I've kept the portfolio size at this. If not, I might run out of patience if I had gone all in. So again, I haven't bought more, but I've kept hold of my holdings. Selling now seems way too late. But buying now really depends on your outlook as well as your starting point. So as always, any questions, leave them in the comment sections. And we'll run to a third segment, which is actually what has recently been announced that might possibly suggest you to buy into China more aggressively. There's a particular tipping point that I'd like to focus your attention on. Before we address that, let's answer this question. Is this the first time that China is doing a rescue package? The answer is no. October 30th, 2023, an increasing number of Chinese listed firms unveiled share buyback plans, of course being pressurized to do so, correct? Maybe that's why Jack Ma and Josai have bought more than $200 million worth of their own stock. November 11, 2023, CSRC has said that banks, security funds, and other long-term investors are encouraged to invest in tech innovation bonds. Now this of course to spur the tech sector, which was once their shining light. November 27, 2023, Beijing Stock Exchange has implemented new policy to prevent major shareholders from selling their stock. So this again to restrict supply, which is market manipulation. 1st of December 2023, state-owned China Reform Holdings has bought into tech-focused index funds. Now this is plain and simple market manipulation by being the last buyer. January 5th, 2024, Beijing has informed some money managers to prioritize the launch of equity funds over other products. They don't want any more fixed deposits. They want people to pour their savings into equity markets. And the list goes on and on. But what's most crucial is right at the top. Premier Li Qiang has announced that they will be taking aggressive steps to calm markets with this new potential rescue package. They will be stepping up medium and long-term fund injections into the capital markets. And sources are reporting that could be 2 trillion yuan worth, which is about $278 billion. This is the key part. Will this $278 billion rescue package really come into fruition or not? Too many times, investors have been promised something and yet been left holding the bag. That's why when I looked at this report, something startling came to my mind. It's mentioned that this stabilization fund could come as soon as this week. And if I interpret it correctly, that means end of January 2024. That is why markets have actually rallied today in anticipation. But what I'd like to suggest to you is if you're keen in buying to China, might as well wait whether this policy implementation is going to come into fruition. Whether it's as aggressive as one thought. If not, all this hype is for nothing. You are much better off waiting for this to come in. Markets rally some distance. Because China and Hong Kong is just way too depressed, you might not need to catch the bottom right here. You can have the luxury of waiting for sentiment to turn and having this rescue package show some momentum first before investing more aggressively. If you don't like China, this doesn't change much, I understand that. But if you're looking for deep value, Hang Seng Index right now is 10 times PE. That's super cheap already, crisis level. And you've seen before that every time it reaches crisis level, it rewards shareholders tremendously as it's very likely a market bottom. Again, my point is, wait for the sentiment to turn, keep a keen ear and open mind, because if this takes effect and it's the start of things to fall, then finally that could be that reversal. Take note again, in 2009, global financial crisis, US government has been trying things for a year and nothing worked. The banks will be collapsing left, right and center. And after multiple injections of funds, the last one being President Obama's $787 billion stimulus, that markets finally started to rally from March 2009 onwards. If you agree also, smash the like button. And thank you for staying right there. I have this bonus tip for you. If you are not convinced about China, I understand. But I'm still bullish on emerging markets. And that's why I like to suggest that right now on the markets, there are MSCI non-China emerging market ETFs. And the latest news is they have even grown in size that's bigger than the pure China ETFs. Previously, ex-China ETFs were only at $164 million at the end of 2020. Today, they are $6.8 billion worth, doing close to a 50x in demand. Quite clearly, investors are willing to invest in emerging markets, maybe just not China. And if you are keen, this one by MSCI invests primarily to India, Taiwan, Korea, and Brazil. Top holdings include TSMC, Samsung, Reliance Industry, and HDFC, which are some companies that I've covered very recently in this previous sharing. Why I view India as possibly a good prospect for the long term. If you haven't seen it, check out this video and continue learning about emerging markets, which could be very useful in your portfolio. As always, thank you for watching right there, and I'll see you there. Invest safely. Goodbye.